Everyone, welcome to another CEO Wisdom podcast. Today with us, we have Ashley Osborne. He is CEO and co-founder at Duval Global, a very cool prop tech company. So we're going to talk about a bunch of interesting topics today. Ashley, can you tell us a bit more about yourself and a bit more about Duval?
Sure. Hi, Charles. My name's Ashley. I've been in the real estate industry now for about 20 years. Predominantly working in places like Asia and Europe in the new build residential market. And I guess what I found in that space was that nobody really got a good deal, right? So you had first home buyers that couldn't get on the ladder. It was really hard for them to buy property. And at the same time, you had all of these investors, and I think you've got the same problem in Canada, where these investors are coming in and they're trying to buy property as well. And you're putting both of those groups in competition with each other. And what we thought was, why not find a better way to actually put those two groups of buyers together and create aggregate them together using an algorithm where we could create a trading discount where the more volume that they bought, the bigger the discount they could get from a developer. And essentially that's where the concept started. We built an algorithm around that concept. We built a prop tech platform. And essentially what we've been doing is building around that now to give greater certainty. So people can see research, they can do financial models, and they can understand all of the different things that they might want to do if they're buying their first property or investing in building a property portfolio.
Pretty cool. How was the shift from employee to full-time entrepreneur and CEO that you made, I believe, 3 years ago?
It's definitely been a journey. I think it's been a great one, and I think it's been really rewarding. But I think the thing that happens as you spend a lot of time working in a large industry company around the world. I was at Colliers for most of my career, so large real estate surveying firm. I was a pretty senior executive at a global level within the company. And I think you forget along the way a lot of those things that you used to do when you were younger. So it's quite interesting that you suddenly wear the hat of the marketing person and the CTO and the accountant and the person that's building the product. So it's been really interesting, but it's definitely been a journey, but it's something that I've really enjoyed. And, looking back now, I don't think I would have changed what I've done, but it's been great to go on that process.
So tell me a bit more about Duval. Basically, how many clients do you have, and what numbers are you aiming for 2020?
So we're still very much in startup phase. So we've been coding for the last 2.5 years, building our product. We're at now what I would call MVP. So that's been a real learning experience in terms of what's required to build a tech product. And what we found is there's a lot of mistakes that get made on the way, and we certainly made most of the mistakes that everybody else did, if not more. In terms of we make a market, so we create a market of both developers and investors. Our first challenge was getting developers to buy into what we were trying to do, because obviously we're selling their product at a discount to what somebody else could buy it for in the sort of open market. So we've done really well in that space. We've got a lot of large developers to understand what we're trying to do. We're now working with most of the UK's big house builders and developers. And I guess the next part of our problem is trying to find our market fit. So we're building momentum. We're getting good numbers in terms of people joining our platform on a daily basis. But our real plan between sort of now and the end of the year is to get to that sort of 15 to 25,000 members by the end of 2023. And that's kind of a pivot point in where we see a tipping point in going from sort of a really interesting platform to something that really has legs. And that's kind of our target for this year.
Can you define the members? Are they just subscribers and being alerted every time there is a new project? How do you define them, and how would you gather these 15,000 members?
So we've got a freemium product. So there's a paywall on our product, so people can come and they can see what we're doing. They can see the products that we have for sale, but they can't use a lot of our technology. The reason being is it's pretty expensive to build. Once somebody joins and subscribes to our platform, they have 3 basic products that they can use. They can see real-time market research, so they can see specifically what's going on in any real estate market that we cover with postcode data, so they can look at a specific level. They can then build a financial model to show them what the net return is after tax for any investment that they might buy. And then finally, we aggregate these investors together over 30-day trading blocks, where essentially the bigger the chain of investors and buyers that gets collected, the greater the discount. And at the end of 30 days, they essentially exchange contracts with the developer. So that's the product and the journey. In terms of the customer base, it's predominantly in Asia Pacific. So Australia, New Zealand, Singapore, Hong Kong, Malaysia, where we predominantly see interest at the moment. But we see ultimately a product market fit for most markets that we do what we do, where there's a new build product. And that's how we essentially create that trading discount.
And let's say 15,000 members, cost per acquisition of each member around $10 if you're lucky. That's like 150K in ad budget. Like where do you want to get these members? What marketing strategies do you want to use to acquire them?
So from our perspective, it's really the thing that's difficult with our products is the fact that it doesn't really exist. So we are genuinely a pioneer in our market. We've done something completely different, and we've kind of turned the real estate market on its head. That's good and bad. The great thing about it is when people are engaged, they're really engaged and they really understand it. But the problem is it requires a lot more explanation to get people's head around what we're actually trying to do. So where we've had success so far has been social media. So things like Google Ads, Facebook, we're growing on Instagram all the time. We're just about to start a TikTok channel. So it's those sorts of things that are starting to work well. And then it's really two things in that space. It's building the funnel at the top, so making sure that we've got enough people going in, but then trying to improve that customer journey for somebody as they go through the funnel, so they can get a better understanding much quicker about what we're trying to do and a better understanding and actually really buy into what we're doing. Because what we're finding is the people that really want to be part of our journeys are the people that really understand why we're trying to do what we're trying to do, which is reduce the cost of real estate for everybody.
Correct. I was wondering also about LinkedIn. Do you view it as a potential candidate for your ads? Because you're at the end of the journey, you're targeting investors. Investors, I mean, yeah, they can be like mom and pop and normal 9-to-5 folks, but a lot of them are leaders as well. Have you thought of using LinkedIn to acquire more members?
We've tried LinkedIn. We're using LinkedIn for some outreach at the moment. We really like the Sales Navigator product and the fact that you can actually target specific groups. And actually where it's worked really well is we've worked in this industry for a long time. So for example, we know that dentists and doctors generally buy real estate as an investment.
Yeah, engineers, architects.
Engineers, those sorts of things. So it allows us to target those specific groups. And again, it's what we've been finding is trying to find the messaging that resonates with that particular group and why, trying to get them to understand why what we're trying to do and get them engaging with us. But yeah, we're definitely starting to see some early signs of success with that.
Yeah, LinkedIn outreach, I would view it more for the other side of the platform, although targeting landlords is hard. Although like some people, they establish companies and are present on LinkedIn, because the LinkedIn ads side of things is not really appealing. The cost per lead is so goddamn expensive. Like in my field, I think it's probably around $80 just to get a lead, right? And that doesn't mean that they'll convert into like a subscriber or a paying client, for example. So talking about the other side of the platform, how do you reach out to potential developers?
Well, we've been lucky in that space. So the one advantage you've got as coming to being an entrepreneur later in your career is you tend to be relatively well known in your industry, and you tend to know most of the clients that you're probably going to work with over a period of time. So that hasn't been so much of a challenge from our perspective, because we've probably got a pretty good Rolodex where we can make contact with most major developers, certainly in the UK, and in places like Australia, we're relatively well known. And because I ran Colliers International globally from a residential perspective, it kind of resonates a lot with developers. So it's been less of an issue in that space, which is why, why we haven't used LinkedIn as much for advertising, because, that that's kind of where we would see we needed to get those people had we not already been in contact with them.
So the business model is so simple that it's beautiful, but it also begs the question. So it's basically bulk buying discount.
Yes.
Why? Well, first you have like similar SaaS competitors, aka other prop tech companies doing that. And why wouldn't Colliers be on these tracks and also be doing something similar?
Well, that's an interesting question, actually. So I had tried Colliers to try and get the company to move in that direction. And having done it now, I can see why there was so much resistance. Because the reality is what developing a SaaS product essentially is going to somebody and saying, look, I've got this idea. I think it's really good. I don't know how much it's going to cost to build, and I don't know how long it's going to take to make, but don't worry, it's going to be amazing. And that's quite a difficult scenario for a large corporate. So there's that financial and risk versus return scenario for a lot of the big corporates. But the other thing is just capability. Building a digital product requires a huge amount of really technical people. Now, real estate agencies have got technical people, but they're they look at real estate from a technical perspective, not from an IT and development perspective. So I think that's probably one of the main reasons. And I think the other thing, in terms of why it doesn't exist, the reality is this is really difficult to build. And I think that's been the problem. There are two issues to building a prop tech in our space. Firstly, building the actual product itself, getting the UI, UX right, making sure it does what it says on the tin. But the other thing then is market reach, because we're not going from a B2B market, we're going to a B2C market. And that's obviously a much more expensive process to go through to actually get customer engagement. So that's perhaps why people haven't been doing it so far. The other thing we've done is we patented all of our technology along the way. So we've tried to put some barriers up for people that want to compete. You can see our patent details on our website if you're worried. So it's those sorts of things, but certainly every time we speak to people, they say, we're really surprised that this doesn't already exist.
I'm curious also, as per the model, just before I get to like the revenue question, how do you get like all of these people to buy at the same time, like technically speaking? Because at one side of the platform, it's cool because you bring the developer a bunch of buyers / investors in bulk, and that has like more effects than just giving them the cash, right? It also fills a part of the building, and that generates momentum and traction, which is exactly what they're looking for. They can also get loans to finish out the construction and finalize all the details, which is super attractive for them. But how do you get all of these guys to like pay at the same time? Do they like drop in the money and then you make them one big wire transfer? Like, how does that work?
Okay, so that's where the complication comes in. So in terms of the first part of your question, yes, what we do is we reduce sales market risk for developers. So if you're developing a new building, you essentially have a land, a planning, construction, sales, and finance risk. We try to reduce as much of that risk as we can for a developer. That therefore means that their profit expectations for that element of a sale is reduced, and we can pass that discount on in full to the group of investors or buyers buying. In terms of the physical mechanics of actually doing that, the reason we work through a 30-day trading cycle is to actually herd everybody into the same process. So what essentially we do is we promote projects at their retail price. Every time somebody reserves an apartment, we have what we call the dynamic price. And the dynamic price reduces for every single apartment or house that's being promoted within that algorithm over that 30-day period, even if they've already been reserved. And then at the end of the 30-day period, each different apartment or property in the algorithm has either hit a pre-agreed strike price that everybody can see before the marketing starts. And if that happens, the reservation fee that somebody put down becomes non-refundable, and then they've got a 7-day window to exchange contracts. And we do that with a combination of altering a developer sale and purchase agreement. We have pretty sophisticated AML software, which allows us to verify that people are who they are, and we've got a specific process for that. And then we use solicitors that we know that facilitate the exchange where it becomes a collective transaction. So
Okay.
that has been one of the big challenges of building what we're trying to do.
So is a typical cash down that someone needs to send to reserve one of these units, saying that the average price is 400K USD? Do I have to drop a 30K to make a reservation, or is it higher, lower than that?
No, so it's important to understand that what we do is our dynamic pricing algorithm is just a price setting mechanism. So it's not a sale mechanism. So essentially, once we've set the price, any buyer that's purchased goes into a normal sale and purchase agreement. It's just fundamentally altered with a couple of different clauses we put into the contract. So the way that most people buy for a new build scenario changes from country to country, but essentially it requires a reservation deposit, which is what you put down with your credit card on our platform. And then you exchange contracts once you've met the strike price, and you do that with a lawyer or a conveyancer, depending on the country. And then that, you then put the funds down either 14 or 21 days after you're in contract. You've got a legal entitlement to the property, and that goes through the lawyer's escrow account. So what we wanted to do was make sure we had a facility where people's money was always protected. So you only either put down a deposit with a credit card, which is obviously protected by the merchant service, or you put money via your solicitor in escrow to another solicitor's account. So we actually don't hold any of our customers' money because we think that just doesn't make sense.
That's pretty clear. Thank you for that. Okay, we talked about the fees of one side of the platform, the B2C, if you want. To me, like I'm always interested in the big bucks, and so are you probably. On the other side of the platform, the developers, do you take a percentage also of the? So let's say that you have a buyer. Me personally, I would take a percentage of their payments, or I would negotiate that with the developer, like, I don't know, maybe like 1, 2, or 3%, and 3% on 300K is like 9K. So that's a lot of money. Do you take a percentage on the developer side of things?
Yeah, that's right. So what we do is we generate revenue in two ways. So firstly, we have a subscription fee that people pay to be on and use the platform. The interesting thing about our platform is you can use it to buy other real estate. So you can use our research or our financial models to work out whether you're getting a good deal on another property. And we've had a couple of customers already say, I was actually able to negotiate a 10% discount using your financial model with another property because I could show what the return was. So we charge a subscription fee for that. And then every single transaction we do, developers pay us a transaction fee, which is fixed for each different transaction. And we keep that separate to the discount. So 100% of the discount goes to the investor, and we just get the transaction fee. And then the other thing that's important about our platform is we want to make sure that our customers get absolute value from their subscription fee. So should we provide additional services like a mortgage or furniture, etc., whatever discount we negotiate with the third-party provider, we ensure that that discount then goes to the investor too. So, for example, you can buy furniture on our platform cheaper than most of the furniture manufacturers retail it for at a retail level, or mortgage brokering services, all those sorts of things.
Pretty exciting. So in terms of revenue percentages on the B2B side vs the B2C side, do you expect making more money on the B2B side? Would it be 80% B2B revenue and 20% B2C from the subscriptions?
Yeah, I guess the jury's out to a certain extent on that. I think longer term, from our perspective, what we would like to do is go one step further. We can see a model where we just charge a subscription fee and we give a certain element of whatever transaction fee we get back to the buyer as well. So we think there's a model there too. Okay. What I suspect will happen is the B2C revenue will be higher to start with, and as subscriptions grow, subscription revenue will be more important, and ultimately that commission might be just something that we think, is it really worth continuing to take? Really?
That's interesting. Mm-hmm. Yeah, I see the big bucks really with the the B2B percentage side, taking a percentage of like huge amounts. which I think is the most interesting thing in prop tech, that the big money made on small percentages of transactions. It's the realtor model, basically. Like here in Canada, as you know, we have these realtors and they take 5% commission,
Yep.
and they're the guys we see rolling here in Quebec, in Bentleys and in Aston Martin. It's funny here because we don't have much tech here in
Mhm.
Canada, and the top guns in that society, that small society, are realtors that take these small commission fees. But yeah, that interesting thesis. I love the MRR model as well. It's definitely predictable, and I think VCs would tend to prefer that one. Talking about VCs, are you thinking of getting some funding anytime soon?
We're not currently thinking about getting funding. I think from our perspective, it had always been that we had a very clear vision of where we wanted to get to. Again, one of the advantages of coming to entrepreneurialism late is you tend to have a bit of money behind you. So
Yeah.
we've been able to seed all the way through to MVP.
Nice.
Will we raise money in the future? Potentially. We've been offered money in the last few years, but at the moment, I think we really want to keep pretty true to our roots and make sure that we're delivering exactly what we say on the tin. Because I've been part of other prop tech companies, and I think the issue that they've had is they've been so diluted along the way that ultimately the vision that they set out with has become something completely different because the investors have driven decision making. So it's all about where we want to go, and I think at that point in time, when we're a bit closer, I think we might consider funding.
100%. So this year you have the MVP. So I guess revenue should be projected somewhere under like 500K. Let's say five years down the line. How do you see the business? Do you see it as the $10 million a year behemoth? How quick can that thing grow?
We think there's a lot of legs in this market. Obviously, residential real estate is a ubiquitous asset across all countries. There is a shortage of housing in most markets around the world. And what we sort of see is there's going to be this big challenge between what we would say is sort of the institutionalization of real estate. So we're going to see a lot of funds move into the residential space, and they're going to take up a lot of this new demand, and it's going to price first-time buyers out of the market. And I think the beauty of what we offer is the ability for a blended mix of both buy-to-let investors, but also first-time buyers. So we think there's a pretty huge market in most places around the world, places like Australia, New Zealand, the UK, other parts of Europe, Canada, etc. So we think there's quite a lot of legs. It's just a question of how quickly we can grow and what sort of market traction we get.
100%. And definitely something playing for you is, and I think both of us know that these Asian investors, like in China, so many millionaires, although China, a lot of people are predicting that things are not going to go super well. And you take these buyers, they are somewhat conservative investors. Conservative, I mean, somewhat applies to real estate. It's very predictable. And so these guys want to invest money, they get discounts, they get better ROI with your platform, and you already connected in that field. And then you have the contacts in other markets in the world. So you have that international aura, I think, that is playing pretty well for you.
We hope so. That had always been the thesis behind our business, was that I think Asia, there's two things with Asia. It's one, knowing how to connect with Asia, but also it's not having the fear of going to Asia. Because I think a lot of people and companies, especially young entrepreneurs, don't want to go to Asia because it's quite a minefield of different things to navigate. And I think the big advantage our team has is I lived in Hong Kong for 10 years. I've spent a lot of time in Singapore and China and India. Then the rest of my team came with me from Colliers, and they've also got similar experience. So we're not sort of, there's no fear of sort of turning up to Mumbai and saying, we're here, we're going to go and speak to 60 or 70 different investors. And so it's those sorts of things, I think, that give us the edge.
Yeah, it's the same edge that I play with my business. Some markets have the money, they have the offer, and some other markets, they have the demand, and us, we're kind of the middleman in between, and we're not scared to explore various markets. Last question for you. Where do you see the markets going this year with this recession that a lot of people are feeling or smelling? And where do you see the markets going, the real estate ones, in the next 5 years?
So that's quite an interesting question because I have a very different view to a lot of people. Look, I think I'm not an expert on a lot of the North American markets, so I'm not sort of going to talk to them other than, North America looks like it's a tough time ahead. But I've got this theory that there's just too much debt at the moment in the markets. If you look at public and private debt collectively, it's about 320% of GDP globally. And it's very, very difficult for central banks to keep rising interest rates. Even if they say they're going to tackle interest rates head on, I think in a game of chicken between central banks and inflation, inflation wins, because the consequences of raising interest rates too high are too much for anybody to imagine. So I sort of see we're going to have a situation of relatively low growth, relatively high interest rates, moderate interest rates, and sort of a really odd employment market because migration doesn't work like it used to. So in periods of stagflation, real estate tends to do really, really well. And if you look at a market like the UK, for example, the last period of time that they had stagflation was between 1970 and 1980. And in that time, the average house price grew by 436%. So, I kind of see that there's going to be there's a headwind ahead within 2023, but I think there's some pretty good opportunities for astute investors because the market's been turned on its head. Those major markets where people would have bought, like London or Toronto or those sorts of things, haven't grown as much because people have moved to remote areas to sort of live in sort of tin sheds and work off the grid. The reality is the recession is going to bring them back to centers. And I think that's where we're going to see the growth. It's those blue chip real estate assets. And I think that's where I see the growth. And I think it's probably a pretty good 5 years once you get past the hump.
Interesting. Thank you for sharing that. And thank you so much for showing up today, Ashley. Where can people find out more about you and Duval?
The best place to find us is we're at www.duvalglobal. That's DUVAL global.com. You can follow us at LinkedIn. We've got a site there, or you can follow me on Twitter. I write under the handle @PropTechPioneer on Twitter. Follow us and talk about the markets and what's going on. And feel free to DM us. We love hearing from people in our space.